Okay, thought I'd put together a little video for you to show you very just quickly how to do a bracket order. I just grabbed a stock chart Ford, which has come off of earnings. They met their earnings expectations. Stock price has gone on sale, it's dropped. And the reason I picked it is because, one, it pays a dividend, two, it's in a known support resistance zone, and in a primary trend zone. The volume's tapered as the prices have dropped post earnings. The earnings they came out and they met their expectations, and prices have gone on sale. And so what I'd really be looking for is just a modest turn up, nothing crazy, but an opportunity to get in, and to do so with some fixed risk. A couple of things we need to know. The average true range, the average daily movement's 29 cents, so we'll round it off to 30 cents. Just call it 30 cents. Now we know that that's kind of typical fluctuation in price. And so our game plan here is going to be to put in an order to buy with upward confirmation. So I need to buy up above the candlestick high, put a stop loss down below it, and then really look to see if we can get it back up here to fill this gap. Maybe shoot for 1550 target. So what we've got set up here is just a pretty good little reward to risk ratio. Now, the trick is to put in a bracket order so we can set it and forget it. And the entry order to trigger in is a buy, stop, limit. Now, the reason we use a buy, stop, limit is to trigger the stop when prices go up, but to control the price, to keep it in that price zone. So when you use a buy, stop, limit, you get two places to put in the price. You get to put in the stop, and so the first price you put in is the stop. That's the trigger. And then the second price you'll put in will be, in this case, higher, which will be the limit, meaning don't spend more than. So we'll do that. Now, we'll take that concept here, and we'll kind of tie the bracket together so that the first order, the buy, stop, limit, we'll abbreviate that to BSL, triggers a bracket order, which is going to be called an OCO. OCO. One cancels other. Now, to sell it out here at our target, I'll call that the target little price there, that is a sell limit. That means limit means my price or better when we're selling. When we're buying, it means my price or lower. And then the exit order we'll put in is just a sell, stop, market. So the reason we use a sell, stop, market is to automatically guarantee the exit. So now what I'm going to do here is just go in and right-click on the chart and place the order. Before I do that, I'm going to make sure I put the stop loss below the candlestick low, and that low price is 14.14. You can see that data up here when you look at the data window right there, L. That's low. So the candle low is 14.14. This candle high is 14.38. So I want to actually be a buyer above the high. And with some confirmation, I might, actually go ahead and say, buy it for like 14.40. Don't spend more than 14.50. And then put in a stop loss down below. And you can, the tighter you put the trigger and the stop, the more likely it is to get hit with typical fluctuations. And what we have to kind of watch out for here is, the fact that the prices are pushing down, and it might get some whipsaw in there. So we're going to only buy if it's turning up. We're kind of hoping to catch it just like it did here, where it starts to turn up and just kind of runs cleanly. What we are hoping it doesn't do is give us a little whipsaw like that. So we can't control the outcome, but we can see that the candles are there. We got the dojis, we got the tapering volume, we got the zone, the catalyst, and the market also happens to be in a pullback. The S&P's in a pullback. So we'll be looking to place that order, so that's what I'll do. So let me go ahead and do that. Right-click on the chart. We're going to go with the buy custom with an OCO bracket. And you have to change around the order ticket. We'll go with a stop limit, the entry, sell limit for the target, and then stop market. So first thing I'll do is I'll make them all good till canceled. Now they all have to be the same time in force. So I make them good till canceled. We choose the number of shares based off of the exposure to risk. So I'm going to say we'll put the buy stop at 1440. And we'll put in a limit. You know, the limit in this case probably doesn't need to be more than 1445. And that's based off of the ATR is only 29.30 cents, and that's plenty of wiggle room. For the target, I think it can fill the gap, and so I'm really looking at like 1550. So, you know, 1550 for a limit. And then for our stop market, the trigger needs to be below that candlestick low, which is 1414, and I'll go ahead and set it down to like 1397. So now the risk is worst case scenario 1445 minus 1397, which is going to be, what are we looking at there? 48 cents. So 48 cents risk, which is greater than 1 ATR. You typically need to be 1.5 of ATR for a stop loss on this type of a trade. Maybe 1.2 ATRs. If you want to go loose, you go 2 ATRs. Now that's kind of, you know, the idea. So our risk is going to be about 48 bucks. So if your paying threshold is $100, you could do 200 shares. And then, you know, when we get to the target, I'll sell half of those. But I'll use the stop for all 200. So that's the general order ticket. Now just to review, we got buy 200 shares, stop limit, trigger at 1440, limit at 1445. Sell 100, half the position if it gets to 1550. And then a stop loss to exit the whole position if it dips below 1397. Go ahead and confirm and send. And when you see that little ticket right there, that should give you a good visual of what you're looking at. And we'd be looking for that to trigger and kind of trail up for us. So we'll manually trail that stop loss up after we place the trade. And if it goes up, we get filled. If not, we may end up canceling the order. Hopefully this is helpful for you.